Hi guys! Right, so this is part two. This will be looking at limited companies. So if you already know about them, there's not much more that this part of the series will do. Yeah, let's get on to it. So, limited company is the most popular type of company in the UK. It is a legal person of sorts. That means that the people that are employed by the company aren't liable for the sort of cash inflow and outflow of the company. So if the company gets in any debt, then the employees are not required to pay off that debt, whereas in other forms of companies, the trader is the person that is liable. It's under their own name. So a limited company differs from things like partnerships because it is an entity of itself. That means that the company could take people from within the company to court about different issues, and they function through the intervention of real humans. So those people that would take employees or such to court would be the owners of the business. The control owners are people that own one or more shares of the company, and that's called equity. So the owners of the company, as I explained, have limited liability. If a company is to become insolvent, which means that their financial obligations exceed the value of their assets, then its liability is limited to the company's assets that it holds. It can be another company that has part ownership of a company. It's not just a person that can hold shares. So, for example, there could be two companies that own a third. So if Company A and Company B own Company C, and Company A's assets are 10,000, Company B's assets are 10,000, and Company C has separate assets of 10,000 as well. That means altogether, as the three companies, they have £30,000. But if Company C has financial obligations of £20,000 and as we can see, it only has 10,000. So because its debt exceeds the value of its assets, which is 10,000, it is therefore insolvent. If Company A and Company B choose to not invest in the Company C, then it will remain insolvent. Once it's become insolvent, they don't have to invest in it, but it does mean that they're not able to draw out of the company because it's in debt. Company C is the only thing that's liable to pay off this debt, so all it's actually worth is the £10,000 that it has as an asset of its own. Limited companies are required, because of that reason, to use limited or public liability company after their name on any financial documentation. This is to warn people dealing with the company that they hold limited liability. That means if you see limited on any kind of financial statements that you're dealing with, it means that if they ever get to the point where they're insolvent, you might not get all the money you thought you were getting from that person, and they have no legal obligations to give you that money if they don't have it. Liquidation. So if it gets to the point where they're unable to pay off their debt, their creditors may call for liquidation. That means that they're asking them to pay off their debts using non-cash assets. If they go into liquidation, if they need to do this, it means that they have become bankrupt. They're requiring to go into liquidation to give up the company and sell off all the assets that it has that aren't monetary to make up for the assets that it's lacking in terms of finance. The other way that a company can become liquidated is by a shareholder. So it might not be that the company is necessarily in debt, it might just be that it has realised its vision as a company and no longer needs to run, and so it's just doing the final paperwork of closing down. If a company becomes liquidated, they appoint a liquidator to realise what the company's assets are, pay off anybody left that is a claimant, and formally lay the company to rest. there is a order that you need to pay off people once liquidation has, the decision has been made. That starts with preferred creditors, so they include people like HM Revenue. So all the taxes of the employees need, and wages of the employees need to be paid, and any taxes associated with that. You then need to pay off the secure creditors, so anybody that made a loan with you where they placed a security on a specific asset. So the bank might say, okay, we'll give you money to invest in property, but if you don't pay all that money back, then we have rights to reclaim that property. That's normally something that loaners will do so that they have that security in place. And so they come next. And so what that means is if you've given all your money away to your employees' wages, then your secure creditors will have first dibs on the real assets that you have. Unsecure creditors will then come next. If a secure creditor has placed security on an item that isn't equal to the debt you owe them, so say a bank loaned you £50,000 and your real asset that they've put security on is only worth £20,000, then the £30,000 that's remaining becomes under then an unsecure creditation, an unsecure loan. So these come third. They come after anyone who, any secure creditors take their picking, and then the unsecure creditors take the next thing. It's only then that you can share out the rest of the money to any shareholders involved. So it can mean that if the company is going in liquidation because of debt, the shareholders never actually get any money because it's spent on the people before them. Each segment must be paid in full before the others can be paid. That's all for today.